Start by understanding what equity financing really means. In simple terms, equity financing is when a business raises money by selling shares of ownership or equity to investors. Instead of taking out a loan and paying interest, the company gives up a portion of its ownership in exchange for capital. This method is commonly used by startups and growing companies that need funds to expand but want to avoid the burden of debt. Equity financing can come from various sources such as venture capitalists, angel investors, or even through public offerings. The key idea is that investors become partial owners and share in the company's future profits and risks. But why would a business choose equity financing over other options? One major reason is to avoid debt. When you raise funds by selling equity, you don't have to worry about monthly repayments or interest piling up. This can be especially helpful for new companies that might not have steady cash flow yet. Additionally, equity investors often bring more than just money. They can offer valuable advice, industry connections, and credibility. However, giving up ownership means sharing future profits and possibly some control over business decisions. It's a trade-off that every entrepreneur must consider carefully. Equity investors come in different forms. The most common types include angel investors, venture capitalists, and sometimes even friends and family. Angel investors are typically wealthy individuals who invest their own money in early-stage companies. Venture capitalists, on the other hand, are professionals who manage pooled funds from many investors and usually look for high-growth startups. Friends and family might invest smaller amounts, but can be a great initial source of capital. Each type of investor brings different expectations and resources to the table, so it's important to choose the right fit for your business. Angel investors are individuals who use their personal wealth to invest in promising startups. They often get involved at the earliest stages when a business is just getting off the ground. Angels are usually motivated by more than just financial returns. They might want to mentor entrepreneurs or support innovation in their industry. In exchange for their investment, they receive equity, meaning they own a piece of the company. Because they invest early, angel investors take on significant risk, but they can also see big rewards if the company succeeds. Venture capitalists, or VCs, are professional investors who manage funds from various sources, such as pension funds, corporations, or wealthy individuals. They typically invest larger amounts than angel investors and focus on startups with high growth potential. VCs often provide not just money, but also strategic guidance and access to networks that can help a business scale quickly. In return, they expect significant equity and sometimes a say in major business decisions. Venture capital funding is competitive, and VCs look for companies with strong teams, innovative products, and scalable business models. Friends and family can be a valuable source of early funding for startups. These are people who know and trust the entrepreneur personally, so they might be willing to invest even when the business is just an idea. While this type of funding is often more flexible and less formal, it's important to treat it professionally. Clear agreements and open communication help avoid misunderstandings down the road. Remember, mixing business with personal relationships can be tricky, so it's wise to set expectations from the start. When a company grows large enough, it might raise funds by selling shares to the public through a stock exchange. This process is called an initial public offering, or IPO. Going public allows a business to access a much larger pool of capital, but it also comes with increased scrutiny and regulatory requirements. Public companies must regularly disclose financial information and answer to shareholders. While the rewards can be significant, the process is complex and not suitable for every business. Determining how much equity to offer investors depends on the company's valuation. Valuation is essentially an estimate of what the business is worth. Factors like revenue, growth potential, market size, and competitive landscape all play a role. Startups often work with investors to agree on a fair valuation before finalizing any deals. The higher the valuation, the less ownership you need to give up for the same amount of money. Getting this right is crucial for both founders and investors. A company raises new equity, existing owners' shares are diluted, meaning their percentage of ownership decreases. For example, if you own 100% of your company and sell 20% to an investor, you now own 80%. Dilution isn't always a bad thing. If the investment helps the company grow, your smaller slice could be worth much more in the future. However, it's important to understand how each round of financing affects your stake and long-term control. Equity financing is often compared to debt financing, where a company borrows money and agrees to pay it back with interest. The main difference is that debt must be repaid, while equity investors are paid back through future profits or an eventual sale of the company. Debt can be less expensive in the long run if the business is successful, but it comes with the risk of default. Equity, on the other hand, doesn't require repayments, but you give up some ownership and control. There are several advantages to raising money through equity financing. First, you don't have to worry about monthly loan payments, which can free up cash for growth. Second, investors often bring valuable expertise and connections. Third, equity financing can improve your company's credibility, making it easier to attract additional funding or customers. However, these benefits come at the cost of sharing ownership and decision-making power. Of course, equity financing isn't perfect. The biggest downside is giving up a portion of your ownership, which means sharing future profits and possibly losing some control over business decisions. Investors may want a say in how the company is run, especially if they own a significant stake. Additionally, raising equity can be a lengthy and complex process, involving negotiations, legal paperwork, and sometimes even changes to your company's structure. Raising equity financing typically involves several steps. First, you'll need to prepare a solid business plan and financial projections. Next, you'll pitch your idea to potential investors, either through meetings or pitch events. If investors are interested, you'll negotiate the terms of the deal, including valuation and ownership percentage. Finally, you'll complete the legal paperwork and receive the funds. Each stage requires preparation and clear communication. Successful pitch is more than just numbers, it's about telling a compelling story. Investors want to know why your business is unique, how you plan to grow, and what makes your team the right one to execute the vision. Practice your pitch, anticipate tough questions, and be ready to explain your financials. Remember, investors are betting on both your idea and your ability to deliver results. Negotiating with investors is a crucial part of equity financing. Key terms include the company's valuation, the percentage of equity being offered, and any special rights or protections for investors. It's important to strike a balance, offering enough to attract investment but not so much that you lose control. Many founders work with lawyers or advisors to make sure the deal is fair and protects their interests. Equity financing involves legal agreements that outline the rights and responsibilities of both founders and investors. Common documents include shareholder agreements, term sheets, and stock purchase agreements. These contracts cover topics like voting rights, board seats, and what happens if the company is sold. It's essential to understand these documents and seek legal advice to avoid surprises later on. After raising equity, maintaining good relationships with investors is key. Regular updates, transparent communication, and involving investors in major decisions can build trust and keep everyone aligned. Investors can be valuable allies, offering advice, introductions, and support as your business grows. Treating investors as partners, not just sources of money, can lead to long-term success. Many companies use equity to attract and retain talented employees. Stock options or shares can be a powerful incentive, aligning employees' interests with the company's success. When employees own a piece of the business, they're often more motivated to help it grow. However, offering equity requires careful planning and clear communication about how and when employees can benefit. Equity crowdfunding allows businesses to raise money from a large number of small investors, usually through online platforms. Each investor receives a small ownership stake in the company. This method can be a great way to build a community of supporters and raise funds quickly. However, it also means managing many shareholders and complying with regulations designed to protect small investors. Sometimes early-stage investors use convertible notes, which are loans that convert into equity at a later date, usually during a future funding round. This approach allows startups to raise money quickly without having to agree on a valuation right away. When the next round happens, the note converts into shares, often at a discount. Convertible notes can simplify early fundraising but come with their own risks and complexities. Safe or simple agreement for future equity is another tool for early-stage fundraising. With a SAFE, investors provide money now in exchange for the right to receive equity in the future, usually when the company raises its next round of funding. SAFEs are simpler and more flexible than convertible notes, but they still require careful negotiation and clear terms. In issuing equity, companies can offer different types of shares. Common stock is usually held by founders and employees, while preferred stock is often given to investors. Preferred shares come with special rights such as priority in receiving dividends or proceeds if the company is sold. Understanding the differences between these types of stock is important for structuring deals and managing expectations. Capitalization table or cap table is a spreadsheet that shows who owns what percentage of a company. It tracks all equity holders, including founders, investors, and employees, and how their ownership changes over time. Keeping an accurate cap table is essential for making informed decisions about fundraising, hiring, and future growth. Investors typically want to know how they'll eventually get a return on their investment. Common exit strategies include selling the company, merging with another business, or going public through an IPO. Planning for an exit helps align everyone's goals and can influence decisions about growth and fundraising along the way. Bringing in outside investors can change a company's culture. New stakeholders may bring fresh ideas and higher expectations, but they can also create pressure to hit growth targets or change the way things are done. It's important for founders to maintain their vision while being open to input from investors. Balancing these influences is key to long-term success. If your company operates internationally or has foreign investors, equity financing can become more complex. Different countries have their own rules about ownership, taxes, and reporting. It's important to work with legal and financial experts who understand the relevant regulations to avoid costly mistakes and ensure compliance. Many founders make mistakes when raising equity, such as giving away too much ownership too early, not understanding the terms of the deal, or failing to keep investors informed. Learning from others' experiences and seeking professional advice can help you avoid these pitfalls and build a stronger business. Many well-known companies have used equity financing to fuel their growth. From tech giants to local startups, raising money from investors has helped businesses scale, innovate, and reach new markets. These success stories show the potential rewards of equity financing when used wisely and strategically. Deciding whether to pursue equity financing depends on your business goals, growth plans, and willingness to share ownership. Consider the pros and cons, your company's stage, and the type of investors you want to attract. There's no one-size-fits-all answer, but understanding your options will help you make the best choice for your business. Wrap up: equity financing is a powerful tool for raising capital and accelerating growth, but it comes with important trade-offs. By understanding the basics, preparing thoroughly, and working with the right partners, you can make informed decisions that set your business up for long-term success. Whether you're just starting out or planning your next big move, knowing how equity financing works is essential for any entrepreneur.